Gold and silver took pressure again. And yet here's the part that matters most. They did not break the way some people wanted them to break. That is where I want to begin tonight, because a lot of people can talk noise when the candles are red for a few hours. Very few people can stay calm enough to ask the real question. What held? What slipped? What moved because of fear, and what moved because the structure underneath the market is changing? And that is exactly what we are going to do here. Because this is not just another emotional metals video. This is about the open. This is about pressure. This is about whether silver and gold are still absorbing hits that should have knocked them lower, and whether that tells us something bigger is already happening under the surface. So stay with me, because the first move can fool people. The second move can trap people. But the structure behind the move, that is what usually tells the truth. And very quickly, before we go deeper, my YouTube stats still show that a lot of people watch these videos and still have not subscribed. So if you get value here, subscribe now, and leave a quick comment, even if you just write, Our John AG, because that simple action helps this channel more than you think. Also, join the WhatsApp channel, because short alerts, quick market notes, and fast updates can go there before a full video does, and that matters on days like this. Now let us get into the real story. The easiest headline would be to say, metals were attacked. Fine, but that line by itself is not enough. The better way to say it is this: gold and silver were pushed into a stress test, and the market still did not get the clean collapse that many expected. That matters. Because when a market is truly weak, it does not need much help to fall apart. It slides, it accelerates, it loses important levels, and the bounces get smaller and weaker. But when a market is under pressure and still keeps finding buyers, that is not something to ignore. Now, I am not telling you every pullback is bullish. I am not telling you every dip is manipulation. And I am not telling you one green candle solves everything. What I am saying is that you need to separate a scary move from a structural move. Those are not the same thing. And tonight that difference matters even more because the official market references are still showing elevated levels. On CME quotes, April silver futures were around 72.855, May around 73.170, June around 73.330, while April gold futures were around 4645.5 and June gold futures were around 4677.2. That does not tell you where price must go next, but it does tell you this market is still operating at levels that would have sounded ridiculous not that long ago. So if you are new here, let me simplify the whole setup. Tonight is not just about whether silver ticks up 30 cents or down 50 cents. Tonight is about whether the market open confirms that buyers are still stepping in after pressure, or whether this whole thing was just a temporary hold before another leg lower. That is the fight. And silver makes this more interesting than gold right now, because silver never moves like a quiet, polite asset. Silver moves like it has something to prove. It moves harder on the way up, harder on the way down, and harder when the market is confused. That is why weak hands hate it. And that is why experienced people watch it so closely when the structure starts to tighten. Now, before somebody clips one line out of this and runs with it, let me say this clearly. A strong hold does not automatically mean a breakout. A red session does not automatically mean failure. A premium in one region does not automatically mean the whole global market is broken. And a vault draw does not automatically mean tomorrow morning there is no metal left. You have to keep your head. But at the same time, you also cannot sit there pretending that all of these signals together mean nothing, because that is where people get blindsided. They want every single signal to become total proof before they are willing to pay attention. By then, the market has usually already moved. So what are we really watching into this open? Three things: price, physical flow, and the return of Asia. Start with price. Price is the first thing everyone sees, but it is usually the last thing they truly understand. People look at a red candle and think weakness. They look at a green candle and think strength. But the real question is not the color. The real question is where the move happened, how fast it happened, and what the market did right after. Did the selling find follow-through? Did the bounce get sold immediately? Did the metal recover an important area, or did it only bounce because the market was thin? Those details matter. Then there is physical flow. That is where things get less emotional and more uncomfortable. Because paper can move fast, headlines can move fast, algorithms can move fast. But when metal starts changing category, changing warehouse, or leaving exchange systems, that tells you a different story. And this is why so many people keep coming back to COMEX and asking the same question in different ways. How much metal is really available? How much is simply sitting there on paper? How much can actually move if there is enough demand? That is where the conversation gets serious. And then there is Asia. That part matters tonight because the Shanghai Futures Exchange holiday calendar showed Qingming Festival closure from April 4 to April 6th, with normal trading resuming on April 7th, and with no continuous trading on April 3. In plain English, that means part of the market was offline for a window, and when a major trading center comes back, people watch closely to see whether price action changes once that participation returns. Now, does that automatically mean the second Asia comes back, the whole market flips? No. But does it matter? Absolutely. Because when part of the world is closed, the remaining market can do things that look bigger than they are. Then full participation returns, and suddenly you find out whether that move had real support behind it or not. And that is why tonight matters more than a normal open. Now let us slow down and make the COMEX side simple, because too many people talk about vault data like everybody watching has spent 10 years reading warehouse reports. Most people have not. So here's the simple version. There is a difference between metal that qualifies for delivery and metal that is merely sitting inside the system. That difference matters because in a stressed market, categories that look similar on a screen do not behave the same way in real life. And when you keep seeing stories about silver leaving vaults or being shifted around or the totals moving lower, the point is not to scream that the whole exchange is finished tomorrow morning. The point is to ask whether the system is getting more comfortable or less comfortable. That is the right question. Because even when the market looks calm, a system can still be getting tighter. And once that tightness reaches a certain level, price can start behaving very differently. That is why people keep using phrases like shell game, shuffle, or reclassification. Not because every movement is fake, but because movement inside the system is not the same as metal freely available at any size, at any time, for any buyer who suddenly needs it. That is where the story changes. Now add one more layer. Silver is not just a monetary metal in people's minds. It is also an industrial metal in the real world. So when silver gets tight, the pressure does not come from only one direction. You can have investors buying, you can have traders hedging, you can have manufacturers watching price, you can have industrial users watching ounces. And when those motives start colliding, the market becomes much less simple than a chart on social media. That is why silver can look irrational when it is actually responding to too many pressures at once. Now let me ask you a question, and I want you to answer it honestly in the comments. Do you think the next major move in silver starts with a clean breakout, or do you think it starts by frustrating almost everyone one more time before the real move shows itself? I'm asking that because markets love to humiliate the largest group of people at the worst possible moment, and silver is especially good at that. Now let us move to the macro side, because the metal story is never just about metal. People keep acting like gold and silver live in their own little box. They do not. They react to debt, confidence, currency, shipping, energy, rates, fear, and expectation. Sometimes they react immediately, sometimes they lag, but they are always inside the bigger system. And one of the biggest macro pressures in the background right now is still the debt story. The Congressional Budget Office said in its 2026 to 2036 outlook that the federal budget deficit in fiscal year 2026 is projected at $1.9 trillion, and debt held by the public rises to 120% of GDP by 2036. That is not a social media rumor. That is the official projection. And it matters because markets eventually have to price trust, not just numbers. Now, a normal person hears a number like that and thinks, okay, that sounds big. But the market hears something else. The market hears refinancing risk. The market hears future pressure on rates. The market hears future pressure on the currency. The market hears the possibility that policymakers keep trying to solve one problem by creating another one. And once confidence starts slipping, metals stop looking like old-fashioned relics and start looking like insurance again. That is how fast the tone can change. And no, that does not mean gold and silver go up in a straight line every single day. They do not. Sometimes liquidity stress hits everything at once. Sometimes people sell what they can, not what they want. Sometimes metals drop first and then recover later. We have seen that before. But the reason people still come back to physical gold and silver is not because they expect a perfect chart. It is because they do not trust the system to stay stable forever. That is the core of it. And that trust question gets even sharper when shipping pressure enters the picture. Because right now, one of the biggest mistakes people make is treating the Strait of Hormuz story like it is only about oil. It is not. The World Economic Forum laid out that the current Strait of Hormuz disruption affects far more than energy, naming fertilizers, sulfur, methanol, graphite feedstocks, aluminium, helium, monoethylene glycol, iron ore and steel pellets, and even green hydrogen infrastructure. In other words, this is not one supply story. It is a chain reaction story. And this is where people need to wake up. Because when fertilizer gets squeezed, that is food pressure later. When sulfur gets squeezed, that can hit battery and fertilizer chains. When methanol gets squeezed, plastics and chemicals feel it. When helium gets squeezed, you are not talking about balloons. You are talking about high-tech systems and medical systems. And when a choke point starts touching many sectors at once, inflation does not need permission to come back. It finds its own way back in. That is why these stories matter for metals. Not because every shipping problem instantly sends silver vertical, but because repeated stress inside the real economy weakens confidence in smooth, cheap, dependable global flow. And when confidence in the system weakens, hard assets start getting more attention. That is the bridge. Now bring India into the picture. This is another place where people can get too dramatic or too dismissive. Too dramatic sounds like this: the East has already completely replaced the West and price discovery is over. Too dismissive sounds like this: nothing is happening, ignore all of it. Both are lazy. The better way to look at it is that when a country as important as India begins leaning more on domestic spot behavior for metals-linked products, and when local premiums stay firm, that deserves attention because it tells you demand may not be waiting politely for Western benchmarks to give permission. That matters. It does not mean one country magically resets the whole market overnight, but it does mean the old assumption that one benchmark explains everything is getting less comfortable. And that discomfort is exactly the kind of thing that builds slowly, then shows up all at once. So when people ask why this market feels tense, that is part of the answer. You have pressure from price, you have pressure from physical flow, you have pressure from debt, you have pressure from shipping risk, and you have pressure from a world that is looking less unified on pricing than it used to. That is a lot. Now here's the part many viewers need to hear. Do not make the mistake of thinking you need to predict every candle to understand the setup. You do not. You do not need to know the exact next 5-minute move to understand when a market is becoming more fragile, more political, more emotional, and more dependent on trust. That bigger read is often what matters most. Because there are always traders who think in minutes. There are always speculators who think in hours. But when savers and serious holders start thinking in terms of system risk, that is when the tone changes. And that is why I keep coming back to the same theme. This is not just a price story. It is a trust story. And yes, before we go further, let me say this once more because it matters. If you value this work, subscribe, and make sure you leave some kind of comment below. It can be a real opinion, it can be your view on the open, or it can simply be our John AG. But do not watch silently if you want this channel to keep growing. Also, if you have had some kind of win in your life recently, business, health, family, study, discipline, anything at all, share it in the comments. Sometimes somebody else reading needs proof that progress is still possible. Now, back to the market. Let us talk about the open itself, because the open is where emotion and structure meet in public. Before the open, everybody has an opinion. At the open, price starts choosing which opinions get embarrassed first. And that is why the opening candle gets so much attention. Not because one candle tells the whole story, but because it shows who was leaning the wrong way right before the bell. If we open green, that does not automatically mean victory. If we open red, that does not automatically mean collapse. What matters is what happens next. Do we hold the first push? Do we fill the gap quickly? Do we reject higher prices fast? Do we bounce from a level that should not have held? That is the language of the open. And this is where a lot of inexperienced viewers lose the plot. They expect certainty from a market that offers probability. They expect one signal to answer every question. They expect one move to confirm the whole thesis. That is not how this works. Good analysis is not fortune telling. It is pressure reading. It is seeing where stress is building. It is seeing what stops working. It is seeing which narrative has to work harder than before to keep price under control. And if you want the simplest live read tonight, here it is. If silver keeps absorbing downside pressure and keeps finding support quickly, that tells me the market still has underlying demand that people are underestimating. If gold remains firm while macro risk stays messy, that tells me fear is not leaving the room. And if Asia comes back online and the tone shifts again, then people who treated this pullback as proof of weakness may have to rethink the whole thing. That is why you do not leave too early. Because the market often reveals the truth in stages. First the move, then the reaction to the reaction. That third step is where weak analysis usually dies. Now let me simplify one more thing that confuses a lot of viewers. There is a difference between a market being manipulated in the short term and a market being controlled in the long term. Short-term pushes happen, thin trading happens, fast selling happens, risk desks react, stops get triggered, margins matter. That is all real. But long-term trends do not survive on theatrics alone. If physical demand keeps showing up, if macro stress keeps building, and if trust keeps eroding, then the market eventually has to deal with that reality. Not instantly, but eventually. And that is why some people keep missing these moves. They are looking for one giant movie moment when the entire system admits everything at once. Markets are usually uglier than that. They leak truth in fragments. A premium here, a warehouse draw there, a policy shift somewhere else, a shipping disruption that starts as one headline and ends up touching 5 industries, a debt projection people laugh at until they stop laughing. That is how the big picture forms. Now let me give you another comment question, and this one is important. What matters more to you over the next 6 months? The gold price, the silver price, or the trust level in the financial system itself? Think about that carefully. Because sometimes people say they care about metals, but what they are really reacting to is trust. And that distinction changes how you read the entire market. Now, by the time you are watching this, the members-only video should already be live. So if you want all the major updates collected in one place, join the membership and watch that full breakdown there. Premium members will keep getting more in-depth analysis. And honestly, it also shows who is really following the work closely. And since a lot of you ask for the fastest path to the key points, yes, the WhatsApp channel matters here too. Full videos give context, but quick alerts matter when the market starts moving faster than people expected. Now let us come back to gold for a second, because silver gets the drama, but gold sets the tone. Gold is calmer. Gold is broader. Gold usually carries the signal that larger pools of money care about first. So when gold stays elevated while debt concerns, geopolitical stress, and shipping risk all remain in the background, that is not something I treat lightly. Again, not because gold cannot correct, of course it can, but because high gold prices in a nervous system tend to mean trust is already under strain somewhere. And if gold is the warning, silver is often the amplifier. Silver takes the same macro fear and then adds volatility, industrial demand, thinner liquidity, and much sharper emotional swings. That is why silver can scare people out of the right position at the wrong time. And that is also why silver can explode when the market finally stops treating it like an afterthought. So when people ask me what I am watching tonight, I would say this. I am watching whether silver acts tired or whether it acts cornered. Those are different. A tired market drifts. A cornered market snaps. And if silver starts snapping back after pressure, then all the easy bearish confidence suddenly looks a lot less comfortable. Now, because I want this video to stay simple enough for everybody, let me put the whole case into plain language. If debt keeps growing, confidence gets tested. If shipping choke points spread inflation risk, confidence gets tested. If price holds up even after hard selling, confidence in the bearish case gets tested. If physical flow keeps getting attention, confidence in paper comfort gets tested. If Asia comes back and changes the tone, confidence in one-sided narratives gets tested. That is the game. It is all about what still holds when trust gets tested. And that is why I keep saying the same thing in different ways. Do not let one emotional session blind you to a structural setup. Zoom out just enough to see the pattern, but not so far that you stop seeing where the pressure is building now. That balance matters. And let me give a word to the people who are newer to all of this. You do not need to become an expert overnight. You do not need to memorize every warehouse term or every futures month tomorrow morning. You just need to get better at asking better questions. Where is the demand? Where is the stress? Who needs the metal? Who needs the story? Who benefits from confusion? And what is the market still refusing to do, even after getting hit? Those questions alone already put you ahead of most people, because most people are not studying, they are reacting. And reaction without structure is how viewers turn into victims. Now, I also want to say this to the people who have been here for a while. If you are one of the viewers who has actually built something, grown something, recovered from something, or turned your life around in any way, do not keep that to yourself. Put a short version in the comments. It helps more than you know, and it keeps the atmosphere here stronger than the average fear-driven finance page. Now, back to the close and the open. Sometimes markets do something very important right before a key open. They create maximum uncertainty. They make both sides uncomfortable. They make bulls feel foolish for not selling. They make bears feel brilliant too early. And right in that confusion, the next real move begins. That is the kind of setup I think a lot of people are underestimating right now, because they keep looking for a neat story. This is not neat. This is a stressed, political, emotional market sitting on top of debt concerns, supply chain concerns, and a growing argument over where real price discovery should sit. That is not neat. That is combustible. Now, I am not here to tell you to panic buy at any price. I am not here to tell you every vault report means the same thing. And I am definitely not here to tell you every macro headline instantly turns into higher metals by sunrise. But I am here to tell you that when multiple pressures keep stacking at the same time, smart people pay attention before the crowd does. That is how you avoid getting trapped by the obvious narrative, because the obvious narrative is usually what gets sold hardest right before the market changes its mind. And if that change begins here, around an open like this, after pressure like this, with these background risks still active, then a lot of people who thought they had more time may discover they had less than they imagined. That is why the next move matters, not because it ends the story, but because it may reveal which side has been bluffing. And if you are still with me here, that tells me you actually care about the real read, not just the cheap headline. So, subscribe if you have not already, join the WhatsApp channel for quick alerts, and check the members-only update if you want the deeper breakdown already waiting for you. Because this next stretch in gold and silver is not just about watching candles. It is about reading pressure before pressure becomes panic. And that is the whole difference. Now let us finish where we started. Gold and silver took pressure. They were supposed to look weaker than this. They were supposed to feel easier to break than this. And yet here we are, still talking about support, still talking about elevated pricing, still talking about physical flow, still talking about Asia, still talking about debt, still talking about shipping risk, still talking about trust. That is not nothing. That is the signal. Maybe not the final signal, maybe not the cleanest signal, but absolutely a signal. So watch the open carefully, watch the reaction after the reaction. Watch whether silver gets sold and stays sold, or gets sold and quietly bought again. Watch whether gold acts like fear is fading, or acts like the system still has people looking for protection. And above all, do not let noise make your decisions for you. Because in markets like this, the loudest story is often the weakest one. The stronger story is usually the one building underneath, while most people are still laughing, doubting, or looking the other way. And when that stronger story finally reaches the surface, it rarely asks for permission. It just moves. Let us see who is really ready for that move. And one more thing that common viewers often miss is the difference between excitement and conviction. Excitement is loud, fast, and emotional. Conviction is quieter. Conviction is what keeps people watching the hard days without running in circles. Conviction is what keeps a buyer interested even when the chart looks ugly for a few hours. If you do not know which one you have, the market will teach you the difference the expensive way. That is also why I do not want you chasing every dramatic claim you hear online. Some people will tell you every dip means total corruption. Others will tell you every bounce means the whole story is over. Both extremes can make you dumber if you let them. The better approach is to ask whether the conditions behind the market are becoming looser or tighter. Right now, I do not see a world that looks calmer, cleaner, and more stable. I see a world that looks more stressed, more fragmented, and more dependent on confidence continuing to hold. And if confidence keeps slipping, then hard assets stay relevant. So yes, stay sharp on the chart, stay patient at the open, stay realistic about volatility. But also stay aware of the bigger backdrop, because that backdrop is the reason these moves keep getting so much attention in the first place. This is where weak conviction gets shaken out and strong preparation starts paying off. And for those of you who keep saying you are waiting for the perfect moment, remember this. Perfect clarity usually arrives after the easy entry is gone. That is true in markets, and it is true in life. So do not confuse caution with hesitation forever. Learn, observe, prepare, and act with a plan. That is how normal people survive noisy markets without becoming emotional spectators. And if you are already doing well, keep building quietly, keep stacking discipline, and keep sharing useful lessons below, because strong communities are not built by fear alone. They are built by steady people who keep showing up, together.